Whenever the topic of precious metals comes up, your mind naturally starts processing a flood of conflicting information. If you've been watching this channel for a while, you know that we don't just blindly follow mainstream narratives. When you look at hard, tangible assets like gold and silver, there are really 5 foundational questions that pop into an investor's head. Why should I own it in the first place? What specific types of gold and silver should I buy? How much of it should I own as a percentage of my portfolio or as a percentage of what I want to protect in the future? Where should I safely store it? And how do I eventually sell it when I'm ready to liquidate, when I need the cash? In this video, we're going to tackle that foundational question that sets everything else in motion. Why should I have it? Before we break down the data, a quick disclaimer. This is an educational video. Because I'm recording this for a broad community, a broad audience, there is absolutely no way I can know your unique family dynamic, your tax bracket, or your specific financial situation. Precious metals are a powerful tool, but you always need to sit down and work out the exact logistics of how these principles apply to your unique portfolio. Now, if you want the quintessential reason to own physical gold and silver, it's all about lifestyle protection. You have worked incredibly hard your entire adult life to accumulate the wealth you have. You have built a specific level of personal capital to sustain the lifestyle you enjoy. But right now, the exact purchasing power, your true level of wealth, is under attack. This is especially true if you're nearing retirement or are already actively living off your nest egg. When you transition from accumulation to distribution of that nest egg, you have to design retirement income streams that are reliable, often at a fixed level. And right now, there are 2 distinct economic forces quietly eroding those income streams behind the scenes: inflation and historically mispriced interest rates. These 2 forces, persistently high costs for everyday goods paired with interest rates that fail to outpace real-world inflation, are acting simultaneously. Where does this environment come from? It isn't random. It's a direct mathematical consequence of the unprecedented expansion of the US national debt. For years, the Federal Reserve and the government have used a specific tool, keeping interest rates artificially suppressed. Now, a low interest rate environment is fantastic if you are a massive corporate borrower, or if you're taking out a mortgage now. It's great for debtors, but much less favorable for savers, especially retirees who naturally gravitate towards safety. When you retire, you should absolutely have a portion of your wealth positioned in principal protected safe vehicles. But when opting for those necessary safe vehicles anchored in low yields, if they're met with aggressive compounding inflation, you create a wealth killer. Your principal stays safe on paper, but its real-world purchasing power diminishes. Your staples cost significantly more. Your safe income stays relatively level, and your standard of living takes a massive hit. To understand how drastically the landscape has shifted, we have to look back at the historic milestones. The entire playbook changed in 2008 and 2009. That was the era when the mainstream media fell in love with a fancy new term, quantitative easing. In plain English, it just means printing massive amounts of money out of thin air to inject liquidity into a struggling banking system. That stimulus engine ran hot through 2010, 11, 12, all the way into 2014. It slowed down momentarily, but the precedent had been set. It gets easier in the future to turn that spigot back on, and even more so. Because then came the massive shockwaves of the early 2020s. To put the scale into perspective, during the 2008 financial crisis, it took the government over 5 years to manufacture and inject trillions of dollars of stimulus into the economy. Fast forward to the dawn of the 2020s, and the government printed trillions of dollars out of absolute thin air in a matter of just 3 months. Think about that velocity. We expanded our money supply faster than at any point in human history. As a direct result, our national debt quickly rocketed past the $28 trillion mark, and it hasn't stopped climbing since. If you look at the raw mathematical data on the national debt clock, the numbers are staggering. But the real story isn't just the raw debt figure, it's the debt to GDP ratio. When that ratio breaches 120% or 130%, it means our country owes significantly more than its entire economy produces in a single year. Yet that is exactly the macro picture we're looking at today. When you project the current structural debt load forward, Even without accounting for any unforeseen future crises or massive new spending bills, the mathematical trajectory points towards a national debt exploding towards $45 to $50 trillion. It's a number so large that the human brain can barely contextualize it. We probably can't really. And if you look at the projected debt to GDP ratio under that trajectory, we're looking at a future where our debt load could scale past 180% of our economic output. So how does a government manage a debt load that massive without technically defaulting? They only have a few cards left to play. One of the primary strategies is a concept known as financial repression. The government deliberately uses inflation to systematically devalue the currency, effectively paying off yesterday's massive debts with today's cheaper inflated dollars. Simultaneously, they have to do everything in their power to keep interest rates relatively suppressed so that the interest burden on their own debt doesn't completely consume the federal budget. To understand why they have this power, we have to look back at another massive historical pivot point, the year 1971. Prior to 1971, the United States effectively operated on a debit card system. Under the Bretton Woods Accord, our currency was directly anchored to a hard asset. The government was legally required to maintain physical gold reserves to back up the paper dollars they printed. But in 1971, the administration completely severed that link, closing the gold window and converting our monetary system into a credit card system. The dollar became a pure fiat currency, entirely disconnected from any physical commodity. From that exact moment onward, the guardrails were completely removed. The government no longer needed gold in the vault to print a dollar bill. They could print infinitely, based purely on the full faith and credit of the United States. When you understand that structural shift, you realize why inflation isn't a temporary bug in the system. It is an intentional feature of a credit card economy. And for the retiree trying to live off of a fixed nest egg, that becomes a silent predator. This is exactly where physical gold and silver enter the conversation. And it's a critical factor your advisor should be addressing. Precious metals provide the ultimate time-tested counterbalance to a devaluing fiat currency. If you look at the average modern portfolio, it is completely lopsided. The vast majority of investors have all their wealth positioned on one side of the financial scale, entirely concentrated in dollar-based assets like traditional stocks, bonds, mutual funds, and cash accounts. They have absolutely nothing of substance sitting on the other side of the scale to act as an immediate, heavy counterbalance. And in our opinion, the most effective, mathematically sound, and logistically accessible asset to act as that weight is physical gold and silver. Historically, gold and silver maintain a powerful inverse relationship with three major traditional asset classes: the US dollar, commercial real estate, and the broad stock market. When two assets have an inverse relationship, you don't choose one over the other because it's good and the other one is bad. Instead, you intentionally own both. When the dollar-based assets enter a cyclical decline, your precious metals tend to experience a massive upward revaluation. They switch places across different economic cycles, allowing you to stabilize your purchasing power right through the middle. Let's isolate the US dollar first. Since the Federal Reserve was established in 1913, the dollar has gradually and continuously lost its purchasing power. But after the guardrails were completely cut in 1971, that devaluation accelerated drastically. Let me give you a concrete, real-world example of how this works, because it perfectly illustrates the difference between price and value. Let's look back at the year 1940. If you pulled up to a gas station pump to buy 10 gallons of gasoline, the price was roughly 17 cents per gallon. So to purchase that 10 gallons of gas, you needed exactly $1.70 in paper US currency. Alternatively, you could have paid for that exact same gasoline using currency minted out of 90% physical silver. In 1940, a silver dollar held the exact same face value as a paper dollar. So back then, one single silver dollar and a little bit of spare change would buy you that same 10 gallons of fuel. Now let's fast forward to the modern era. If you pull up to that exact same gas pump today, how many paper US dollars does it take to buy those same 10 gallons of gasoline? Depending on where you live, you're looking at anywhere from $30 to $40 or more. Did the gasoline suddenly become inherently scarcer or vastly superior in quality? No. Did the paper dollar gain value? Absolutely not. It lost an immense amount of value. It takes significantly more paper notes to acquire the exact same physical commodity. But here's the fascinating part of the math. If you take that exact same 1940 physical silver dollar out of your safe today, look at the melt value of its raw silver content, and convert it to modern fiat currency, that same silver coin will still buy you roughly 10 gallons of gasoline. That is the exact definition of maintaining your buying power. The intrinsic value of gold and silver does not fundamentally shift. Rather, the metals act as an immutable mirror reflecting the continuous erosion of the paper currency surrounding them. They have maintained that precise purchasing power for decades, even centuries. This exact same inverse counterbalance applies directly to the commercial real estate market and the stock market. If you map out a long-term historical chart comparing the performance of precious metals against real estate values, the data reveals a beautiful cyclical rhythm. Look closely at the structural shifts around major market disruptions like the 2007 and 2008 subprime meltdown. As real estate values cratered across the country, physical gold and silver entered an aggressive bull market run, surging upward to act as an immediate buffer for diversified portfolios. And we can track decades of data showcasing the same relationship. It can provide an incredible, non-correlated balance, even to a real estate-heavy portfolio. Many of the prospective clients I talk to express concerns about the burden of the rapid inflation we've experienced just within the last several years. And as they choose to work with us and we build physical gold into their wealth portfolios, it's easy to reassure them of their financial security by showing that just in the last 5 or 6 years, the value of gold has risen from just over $1,500 to just over $4,100 per ounce since the beginning of 2020, mimicking the rapid inflation rates that they feel in their day-to-day spending. If you want to see exactly how we integrate alternative assets and tactical risk management into our comprehensive wealth plans for clients, head to the link at the top of the description. You can schedule a direct one-on-one consultation with our team whenever you're ready. Stop letting inflation call the shots with your life savings, and keep an eye on the financial weather radar so that you can protect your downside. And I'll see you in the next video. Take care.